In late 2012, as financial markets drifted toward the end of another volatile year, Bill Ackman was preparing for a moment he believed would define his career. Ackman was not an outsider looking for attention. He was already one of the most powerful figures in modern finance. He was the founder of Pershing Square Capital Management, a hedge fund that at its peak managed more than $14 billion. It had once exceeded $20 billion. He was known for his intensity, his confidence, and his willingness to take positions so large. They forced the rest of the market to respond. Ackman did not merely invest, he prosecuted ideas. By then, his reputation was built on high-profile victories. He had made billions betting against MBIA during the financial crisis, identifying weaknesses in its insurance model long before they became obvious. He had pressured corporate boards, reshaped companies, and convinced investors. Markets were not just mechanisms but moral systems that could be corrected by force of logic and capital. To many, Ackman represented the ideal of the activist investor, analytical, fearless, and unafraid to confront what he saw as systemic wrongdoing. When he turned his attention to Herbalife, he believed he had found his most important case yet, that rewarded distributors not only for selling products, but for recruiting others beneath them. By 2012, the company operated in more than 90 countries, generated over $4 billion in annual revenue, and claimed millions of distributors worldwide. Its stock traded around $40 per share, and its market capitalization hovered near $6 billion. For decades, Herbalife had attracted controversy, skepticism, and regulatory scrutiny, yet it continued to grow. To many institutional investors, Herbalife was unglamorous but lucrative. To Ackman, it was something else entirely. He believed the company's economics depended less on retail demand than on endless recruitment. He believed most distributors lost money, and he believed that when recruitment slowed, the entire structure would collapse. In his view, Herbalife was not simply an aggressive sales organization. It was an illegal pyramid scheme hiding behind consumer products. Ackman did not act on instinct alone. For months, Pershing Square devoted extraordinary resources to investigating the company. Teams interviewed hundreds of current and former distributors across multiple countries. Analysts dissected compensation plans line by line. Lawyers examined regulatory precedents. Economists modeled distributor churn and income distributions. By some estimates, Ackman spent between $30 and $50 million. And when they did, the stock would collapse to zero. That belief shaped not only his trade, but how he chose to reveal it. On December 20th, 2012, Ackman hosted an unprecedented public presentation in New York City. For 3 hours, using more than 300 slides, he laid out his case in exhaustive detail. He accused Herbalife of being an illegal pyramid scheme. He described the company's distributor base as victims. He framed the trade not merely as an investment opportunity, but as a moral obligation. Then he disclosed the scale of his bet. Pershing Square had taken a short position estimated at $1 billion, one of the largest single company shorts ever attempted. In doing so, Ackman crossed an invisible line on Wall Street. Short sellers typically operate quietly, aware that public attention can move markets against them. Ackman did the opposite. He made his trade a spectacle. He tied his personal reputation to the outcome. He effectively dared the market, regulators, and Herbalife itself to prove him wrong. The immediate reaction was dramatic. Instead, something far more dangerous happened. Other powerful investors began to take the opposite side. The most consequential was Carly Khan. Khan was Ackman's ideological mirror image, combative where Ackman was cerebral, instinctual where Ackman was analytical. When Khan began buying Herbalife shares, it was not just a trade, it was a challenge. Over time, Khan accumulated nearly 26% of the company, gained board influence, and publicly mocked Ackman's thesis. Their feud spilled onto live television, where the two billionaires traded insults in front of millions of viewers. As Khan and others bought shares, Herbalife's stock reversed course. From lows near $26, it climbed steadily, $40, $50, $60, then over $70 per share. Each dollar higher meant millions in losses for Pershing Square. Unlike a long position, where losses are capped, a short position has unlimited downside. Critics questioned whether Ackman's moral framing had clouded his judgment. Still, he did not exit. By that point, the trade was no longer just financial. He appeared repeatedly on financial news networks, insisting that the truth would prevail. He argued that markets were temporarily irrational, that powerful interests were propping up a fraudulent system, and that patience would be rewarded. In his mind, being right eventually meant being profitable. Everything now depended on regulators. If authorities shut Herbalife down, Ackman's losses would instantly reverse into enormous gains. Years passed as investigations continued. Finally, in 2016, the Federal Trade Commission announced its decision. Herbalife would pay a $200 million fine and restructure aspects of its distributor compensation system. But the company would not be shut down. It would continue operating. The market's response was decisive. Herbalife survived. The stock dipped but did not collapse. Ackman's long-anticipated catalyst had arrived, and it was not enough. Performance lagged competitors. The firm's aura of invincibility was gone. In 2018, after nearly 5 years, Ackman quietly exited the position, restructuring the short into options and then closing it entirely. There was no announcement, no victory lap, no public reckoning. When opportunity cost and years of underperformance were included, the damage exceeded $1 billion. It became one of the most expensive public investment mistakes in hedge fund history, studied in business schools and dissected by investors worldwide. In later reflections, Ackman acknowledged that while he still believed many of his criticisms of Herbalife were valid, the structure of the trade was deeply flawed. He underestimated how long markets could resist a thesis. He underestimated the power of opposing capital, and he underestimated how difficult it becomes to exit a position once ego, reputation, and identity are intertwined with it. Years later, Ackman would stage one of the greatest comebacks in modern finance, turning a $27 million credit hedge during the COVID crisis into more than $2.5 billion in profit. But the Herbalife trade never disappeared. It remained a scar, a reminder that intelligence, data, and conviction are not enough. The story endures not as a tale of ignorance or recklessness, but as a warning about certainty, about what happens when analysis hardens into belief, when belief turns into public identity, and when walking away becomes psychologically impossible. On Wall Street, the market does not reward moral arguments or intellectual dominance. It rewards humility, flexibility, and timing.